Good morning, everyone. This is a webinar on Kupat Lehashkaa for the Living Financially Smarter group. I'm Rivka Leibowitz, founder of Living Financially Smarter and financial consultant. I'm here with Danny Newman. Good morning,
Hi.
Danny.
Hi, good morning.
Danny is an insurance agent. You want to just say a minute, something about yourself, introduce yourself? Most people probably know you.
Yeah, most people probably here know us by now. So together with Rivka and also Benjamin, so we're the three professional administrators of the group Living Financially Smarter in Israel. I'm a fully licensed insurance and pension agent working for Goldfuss Insurance. And hopefully this will be the next session in the series that we've done, which will help people understand the products a little bit more.
Great. I'm always like, when I want to do these events, I'm like, okay, it interests me because I think it's a good product, but like, will people be interested? And it's just exciting to see how many people watch them afterwards. I think we had like a few thousand even watch the pension one. Yeah. We did Karen Hishtamut, and now we're doing Kupat Lehashkaa, which is also an exciting product. Essentially, I see a Kupat Lehashkaa as a mutual fund with a twist. Danny will explain exactly what it is and what that twist is. These funds have been around since 2017, 16?
The end of
2016. Yeah, to the end of 2016, so they're fairly new. They're not the same as a regular Kupat Gemel, okay? It's a Kupat Lehashkaa. Please understand that there's a difference. And one of the questions that I think we should start with, Danny, is the issue that Americans are like, is this a PFIC? Isn't it a PFIC? So we're not going to answer, but I just want to hear from you what
So first of all, before we go into the American, and then I'll share the screen as well soon, where we can look at the presentation. The name Kupat Gemel is very confusing. So the twist, which we'll come to a bit later on, is that it's similar to a Kupat Gemel for certain people who leave it until retirement age and then transpose it into a pension vehicle and may be able to benefit from certain tax benefits, which we'll look at a bit later. But in essence, you're right, it is a mutual fund. So I'll share my screen. Bear with me 1 second, and then we'll tackle straight away the issue of Americans. Although what I will say is, if you bear with me 1 second. Okay, so you should be able to see my screen. Just give me an okay if you can see my screen or not.
Yeah.
Okay, great. So you covered the first bit, what it is. So I just go straight to US citizens. So it is a mutual fund, and the issue with being a mutual fund, and again, I put my hands up. I am not a licensed US CPA. So whilst I'm licensed in Israel, I'm not licensed in the US. However, the vast majority of US CPAs that I've spoken to have said that this is considered a PFIC, a passive foreign investment company, and potentially likely to be adversely taxed in the US. So therefore, anyone who has that blue passport or that wonderful 9-digit number, 3 figures, -2, -4, the social security number, speak to your US CPA just to see whether it's relevant, because you should know that any financial product here, there is a W-9 form that needs to be completed with this, so it will appear on the records here that if you're a US citizen or not. So any tax issues, please consult with a US CPA.
Okay, so let's take a look at the key points. What exactly a Kupat Lehashkaa is? Let's start by taking a look there.
Okay, so we'll dive right in. So again, I might gloss over a few things, but everything will be here for people to look afterwards as well. But the main advantage is that people get nervous when one's looking to invest in the bank or other places. The money might be locked in for a certain amount of time. With a Kupat Lehashkaa, the money is liquid the whole time. What does liquid mean? It means it's available to withdraw. There are no financial penalties whatsoever. If you want to take it out the next day, the next week, the next year, you're not tied into a certain time. So it's quite a malleable product which allows people to take it out whenever they want. Technically, it can sometimes take a few days because you're in essence withdrawing or redeeming a policy till it gets into one's account, but there are no penalties for withdrawing it. The second thing is the flexibility. You can choose either to do it on a monthly deposit. You don't have to put in a lump sum. You don't have to have huge, copious amounts of money. And you can do it on a monthly deposit, 100 shekel a month, 200 shekel a month. That's not a problem. Conversely, if you've got a lump sum that you want to put in, there are upper limits, which we'll look at a bit later, but you can put in a lump sum in or a combination of both. So it's quite a flexible product. The next thing is also, which we'll look at a bit later as well, there are many different types of investment tracks, some which may have a higher exposure to the stock market, some which may have a lower exposure, and you have the ability to switch in the individual tracks within the same company, or alternatively, you want to move it to another company that offers a Kupat Gemel Lehashkaa, you can do so. There will be no tax event by moving it. The only tax you pay is when you withdraw, which we'll look at the taxation afterwards as well. But you have the ability to chop and change investment tracks. The next thing also is that with the tax, which we just spoke about too, other than the Keren Hishtalmut, which we spoke about in a previous webinar that we did, here when you come to withdraw the money, as with the vast majority of saving plans in Israel, there is capital gains tax on the profits. It's not on the principal. So if, let's say, someone, for simplicity of mathematics, has paid in 100,000 shekel and then wants to take out the money when it's grown to 140,000 shekel, so on the 100,000 shekel they put in, there's no tax. On the 40,000 shekel profit that the fund has made, there will be 25% tax. So you would get 10,000 shekel taken off, but only at the time when you withdraw the funds. So you wouldn't get the full 140, you would get 130,000. The other thing which is important to note as well, whilst and when we look at figures as well, they look very, very good. And historically, they are very, very good. There can be dips in the market. 2008, the financial crash of 2008 was one famous example. 2002, also the markets had a dip, which was after the events of 9/11 in September 2001. So we do see adverse results in the stock market at times, and that means that there can be a time where they lose a bit of money. But historically, as we'll soon see, they do far outperform the interest rates at banks. And the important disclaimer, as with every product, which is a financial product, past performances do not guarantee future ones.
Right. I wanted to comment that very often, when I meet with clients or I'm trying to tell people to live financially smarter, I'm like, just like you pay your mortgage or you pay your rent, and it happens, if you can automate a savings, it will happen too, or an investment. And when you brought up that point about, that you could do monthly, that's what I recommend for people that are, if you have this product, if you're going to want to deposit in any way, automate your deposits. As Danny said, it could be as small as 100 shekel a month, like automate deposits so that it happens. And then at the end of the year, you're like, oh, I didn't need to find the money. It happened. So just wanted to comment on that. Okay, now for the twist.
I just had one thing on that, Rivka. Rivka, I just had one little thing also, is what I found quite often people want to say, oh, I can afford to pay a lot of money a month. And they stretch themselves so much. And after a month or two say, well, actually, can I stop it for a little while? And it takes them years to start it again. It's much better to go in modestly at a much lower rate, and you will find that you will end up saving a lot more in the long run by doing so. So you don't need to overstretch yourself. You can always, as I said, you can always top it up as well. But don't make the mistake of thinking that one can afford a higher amount. And then let's say the air conditioning unit has broken in the home, and so you say, oh, you suddenly got a big expense and you want to stop the things. Do an amount that you can easily do if this is something you're considering, and that way you're forgetting about the money, and slowly that money will build up to a respectable sum.
Yeah, yeah. And sometimes people are like really surprised, like, oh my goodness, like, wow, that really added up. Like, I forgot about it. So,
Yeah.
so that's really good. Okay, now for the twist. Let's talk about
Yeah.
the tax benefits beyond age
Okay.
60. What happens?
So this is a twist, which we'll look at a few examples as well, or an example later on as well. But the reason why this actually came out was to assist a lot of people who are self-employed, earning high salaries, and who, for tax benefits, there's an upper limit for this year of 17,800 shekel, which is the equivalent of that's the income, 17,800 shekel income, where you can put in just under 3,000 shekel a month into a pension and get tax benefits. That's for someone who's self-employed. So this was primarily for someone who's self-employed or employed and has a much higher salary than what they're getting pension contributions on. And they get to retirement with a much lower pension. So this vehicle allows people to keep the money until the age of 60 and beyond. And then they can transpose it into a vehicle connected to this, which will allow you to take as a monthly annuity. If you do so, then the entire fund becomes exempt from taxation on the profits. So it keeps one's options open. You're not making a decision. So let's take someone who's a self-employed doctor at the age of 33 years old, and they've got another, let's say they want to retire at 67, so they've got another 34 years of working, and they may be earning 30, 40, 50,000 shekel a month, and their pension contributions are on a much lower amount. So they're saying, well, I've got income coming in, I would like to save it, and you keep your options open. So if they want to take it out as a lump sum at any stage, they can do so. It's not tied and locked in until retirement, but they will have to pay tax on the profits. However, they keep it until age 60 and then transpose it into a monthly annuity. There is no taxation on any of the profits at all. So what happens is we use an example. So let's say, and I'm purposely going to use a lower example as opposed to someone who's maxing out on what they could put into this. But let's take someone who's earning a decent amount and they can put 1,000 shekel a month over 30 years. So if they're putting 1,000 shekel over 12 months times 30 years, they've put in 360,000 shekel into the fund. Now, assuming the fund, let's say, grows at an average of 5% per year, that fund will grow at the end of 30 years to 832,259 shekel. Now, if one withdraws it as a lump sum, so one after 30 years says, I want to take the full 832,000 shekel out. I don't know, they want to buy a small property for an investment, or they want to help a child out or it's for their own. They were renting, or they then get nervous, that they don't want to rent it long into retirement because they may say, well, if my landlord sells the property, I may not be in a physical state to be able to move, in my 80s or 90s. So they might be concerned. So they say, well, I'll take this fund and I will purchase a small apartment, which will be mine. No one's going to kick me out. So if they take it, there will be 25% tax to pay on the profits. Just to give the illustration. So what is the profit? We'll take the 832,000 shekel less the 360,000 that's gone in. So the profit is 472,259 shekel. The tax deduction will be 25% of that. So there'll be a tax deduction of 118,065 shekel. So the total amount available as a lump sum to withdraw after tax will be the 832,259 that it's grown to, less the 25% tax on the profit of 118,065 shekel. So they'll be able to take as a lump sum amount 714,194 shekel. That's this example. However, if they wanted to take it as a monthly annuity, so the entire 832,259 shekel is allocated to the vehicle that will enable them to take it out as a monthly annuity. So that, in essence, is the twist, is that the 118,000 shekel or so of tax in this example would be allocated towards a monthly annuity and would enhance someone's future retirement fund and monthly pension if they wanted to use this. Now, this was an example of 1,000 shekel. One may put in a lot more than this, and their funds could be a lot greater, and the profits could be a lot greater, and the tax saving could also be a lot greater. But this is, in essence, the twist of this. It is a product that keeps your options open. and you can take part of it as a lump sum and keep part of it as a monthly annuity. Decisions don't need to be made now. That's the twist.
It's a nice twist. It really helps boost people's pension. I just have a question, two questions.
Yes.
One is, if it's taken out after 60 as a lump sum, is it not lower tax at that point also?
So there are questions about it. Again, this is a very new product. There were rumors and there were people talking about it. At the moment, we're not seeing that. Again, I wouldn't base it on it. I would assume at this point in time, 25% tax on profits. A lot of people make the confusion because of the tax benefit after 60. They think, oh, you can also take it as a lump sum without tax. At the moment, no. There is tax. It's 25% tax on profits. Hopefully, at some time in the future, there might be a lowering of that mark for people. But for all intensive purposes, assume at the moment that there's 25% tax on the profits. Anything less is a bonus.
Mm-hmm. And we're being asked by somebody here, monthly annuity for how many months?
So that will be dependent when one gets to retirement age. It's the same with a regular pension. If someone's retiring at 67, you don't have to take the money out at 67. If you delay your retirement, obviously, look, unless you're Elvis Presley, we're all going to die at some stage. So, someone, let's say the average, or if we look at the longevity tables, on average, people will live to, let's say, 84, 85 years old. So someone retiring at 67 is on average going to live for another, let's say, 17 years or so, 18 years. Now, if someone who delays taking out to age 70 has reduced their lifespan in retirement. So I don't want to get bogged down too much on the exact figures, but it will be based on what the mortality tables are showing, what the actuarial tables are showing, and the age one takes it out, and one will then get a divisor based on the age of the person at the time. Their gender would also impact that, and then the calculation would be done. But I can't unfortunately give a precise thing because it really differs depending on the age. And because you can take it out at 60, someone taking it out at 60 or someone taking it out at age 75 can have remarkably different amounts of monthly payout as an annuity.
Meaning, though, that I couldn't, if I said, you know what, I don't need the money. I have enough in my retirement funds coming in, but I don't want to pay the 25% tax. Can I take it out over 5 years rather than until 85 or whatever age they think I'm going to live till?
That's a good question. I'll be honest with you. I don't know if 5 years can be done, but that's something which we would look at. Depending on each individual. Again, as one gets close to 60 plus and wanting to take it out, so then we would then approach various different companies, not just us, but other people who offer these options as well. Would see, because different companies will offer different rates as well, because their actuarial tables may differ slightly. So, depending on what the individual wants to do, one could look to say, okay, what's best for me? I'm 70 years old. It could be someone also 70 years old, and suddenly has unfortunately had a not too great meeting with a doctor and be told that they're not expected to live so long. So they might want to reconsider now, do they do it as a monthly, or do they want to just take it as a lump sum, or do they want to leave it and bequeath it to the next generation or to their surviving spouse or partner? All these are questions which can play out. Again, it's because, it's a very flexible product, so each person can look into what may be best for them financially.
Okay, so let's look into who can open a Kupat Lehashkaa. I see we have a question here also. What's the minimum deposit to start with?
So different companies will have different minimums, but it's usually very, very low. You can do it like 100, 200 shekel. It's some companies may have a slightly higher minimum, but I'm yet to meet someone who's had too little amount of money and not been able to open it up. And I've had people open up with like 100 or 200 shekel. That's not a problem.
Right. Great.
So yeah, so who can? So you're asking, so who can open up? So firstly, anyone who's got a Tudat Zahut. So anyone can do that. The other thing is also you can open up for a child as well, because it's anyone with a Tudat Zahut. So parents can use this as a child saving. A lot of people say, "Oh, my daughter got some money for her bat mitzvah. My son got money for his bar mitzvah. Could I use it?" Again, steering clear of the potential US issues for those who live south of Canada or north of Mexico. So yeah, sure, you can. Now, the issue which people need to know, and this will be an individual thing to realize, is because things are digitalized, a child can in essence get to age 18 and they will be far more technically savvy than their parents may be, and they'll be able to locate and see that suddenly they've got a nice amount of money. At age 18, they have the ability, if they want, to access the money, withdraw it, and if they want to blow it all on a holiday to Ayia Napa, they could do that. So if parents are concerned about that, parents can open up for themselves. You can open up more than one. There is an upper annual limit, which we'll soon look at, but you can have more than one as long as your annual amount each year that you put in doesn't go above that. You can have different funds, and I have some clients who will open up a number of different funds, allocating the amount to a different child because they're saying, well, I want to be in control of the money. Other people say, well, yeah, it's my child's money. I don't want to have that. If they take it at 18, that's their business. There's no right or wrong. That's the individual dynamics of each family. Now, self-employed people who are earning more than 17,800 shekel a month, and we touch on this as well, this becomes a very good vehicle to increase pension savings in a rather dynamic fashion. Now, to look at why it's so good for Atzma'im, let's look at this tax year. So in 2022, the maximum an Atzma'i can pay into a pension, and I know we're going off at a small tangent, but a maximum that an Atzma'i can pay into a pension is 16.5% of a monthly income of 17,800. So the maximum they can contribute per month is 2,937 shekel a month. That amount is the equivalent of a sachir, a salaried employee, earning about 14,000 shekel. So again, if we let's say look at a self-employed person earning 30,000, 40,000 shekel, so they're only going to be receiving a future pension that's the equivalent of someone earning 14,000 shekel. So they can pay a lot more. How much can they pay into the fund? So firstly, it goes by tax year. The tax year in Israel goes from 1st of January to the 31st of December. The maximum for this year, originally it started at 70,000 shekel at the end of 2016, but it's index linked. So the new index linked figure maximum for 2022 is up to 72,616 and 50 agorot. Don't forget the 50 agorot per person. That's the maximum that each person in total can pay in this tax year into Kupat Benefits. If someone's, let's say, got 4 Kupat Benefits, so they can pay just over 18,000 into 4 if they want to, or 60 into one, 12 into another. The total amount. This is approximately just over 6,050 shekel a month. So when we look at going back, what they're paying, 2,937 shekel is the equivalent of a 14,000 shekel salary. They can beef it up and put up to another 6,000 shekel a month, which is more than double again, and they can get a much higher future pension, which can accurately reflect what their true earnings were.
It's really an important product. Like so many people don't know what they're going to have when they retire, and then when they find out, they're like, "Oh, I didn't realize how much lower that's going to be than what I was earning." Obviously, I don't want to scare everyone, but it's just better to know. And then, for non-Americans, how they can fill it in with this product. It really is sort of gift to be able to do this product and not have the tax potentially if you leave it and convert it to a pension.
Correct. And also there are some often what may happen, sometimes people marry out. Some people may have an American spouse or a non-American spouse. So I'm joking with the marrying out, but let's say someone who came with an aliyah from America, or someone who's got an American passport and a social security number because of their parents. If they've married someone who doesn't, so one can utilize their tax efficient spouse, and they can, in theory, use this vehicle and have it in their name. But again, also just to double check that the spouse isn't on the records of the IRS as well, to check with the a US CPA as well. But in theory, that can be done. But a question also which people have as well, there's sometimes people have extra money. People have more than the 72,000 shekel in a year to do. So there are similar investment options to Kupat Gemel, however, without the future tax benefit of the tax-free element for those taking it as annuity. But there are other similar vehicles available where people can put in, I've got clients who put in 7 digits into these things as well. They do exist as well, but usually one would initially maybe look at the Kupat Gemel Lehashkaa, and then anything on top of that, other vehicles.
We'll probably want the Keren Hishtamut first, then a Kupat Gemel Lehashkaa, and then if we've maxed out on both of those, we can consider other vehicles. And it's possible, if I can get you to do this, we could do a webinar on those other vehicles also, just so that people know.
I mean, it's going to be very similar to this, but it's just like without the tax benefit.
Right.
And without the limitation.
Okay, so let's move to loans. I know that a lot of times when people ask on the Facebook group, like, if I take a loan, where should I take from? And, we'll say, you could take against your Keren Hishtamut. You could possibly take against your pension. So here is another option of a place, if you have money, that you could potentially take a loan.
Correct. So in the similar guys, again, not all companies offer it, and they can change the mediniyut, their how and what their policies in this. So just a couple of examples. So these are loan examples where you can take up to 80%, 65%. Some will do 50%. Some will do a prime rate, or some will do linked to the madad. But the interest rates at the moment, 1.62, 2.75%. I won't get too bogged down, but they tend to be a lot lower than the historic returns. So if one, and I always stress, if one can afford to pay the loan, don't get in a situation where you're just spiraling into more debt. That's not the goal. But it could be that someone has saved up, let's say, 50,000 shekel into their fund, and they're making a bar mitzvah, and they want to access some funds. So if you can afford the monthly repayment, it's a way of allowing the funds to continue to compound. So if we, let's say, look at the compound interest, which is this again, something which we looked at. These are the same data that we looked at in the Keren Hishtamut talk, and also in the pension one as well, where just to show examples, someone's saying for 6, 12, 18, 24, or 30 years, 1,000 shekel a month, how much they're putting in, and over time at 4, 5, 6, or 8% interest per annum, just how much it grows. So you take, let's say, an 18-year. So let's say someone took out, put 1,000 shekel a month, let's say, for a child when they were born. And so they put in 216,000 shekel. If it's grown at 6%, which is definitely doable at the moment. Again, what will be in the future, one never knows. But it's a decent return if they keep it in for a bit longer, for another 6 years. So they say after army, after university, after yeshiva, after whichever trip to Thailand or South America after the army, assuming that flights will, and trips will resume to what they used to be before something called Corona, which some of you may have heard of. I don't know
if people are doing these trips since Corona, but
But I'm saying it should that return. So okay, 288,000 grows to about 600 and something thousand, or potentially higher. Again, so that's the beauty of allowing things to compound. And again, this was an example which I did, about the loan value after 6 years. Someone's taking a loan on 50,000 shekel out of this. Let's look at the first year. Instead of taking it out, allowing it to grow for another 6 years. So it's grown to 210,000 at 6%. But if they're paying between 2 to 3% interest, it's very, very, very low. The interest they've actually paid is between 3 to 4,500 shekel is what they're paying on the loan on 50,000 shekel, as opposed to the growth is just. It does for those who can afford the loans. I know people often don't like taking loans, but this isn't, let's say, the standard stereotypical loan where I need to buy my groceries and I can't afford it and I'm just getting deeper into debt. This is in essence a loan against money that you have, which is why the rates are lower and if you can afford it. But it's something which is definitely worthwhile, to consider. Now, what people often ask, where can I check? And this is, again, we've used this in previous talks and in highlighting, saying this is the same gemelnet.cma.gov.il website. It's a government site where one can check the different plans. I've taken a few screenshots where you can see what the options are. So when you go in, you'll see the addresses here, and you click on Knisa Lemarechet, where you go into the system. And then what you can do, you'll see it's got listed here, Kupat Lehashkaa. You can click on that, and then on this arrow here, move it into this, and you press that save doch, and you can find them all. What I've done here, I've looked at all of them. When I load them all, the average return of Kupat Lehashkaa in the last 12 months, so from January to December 2021, they on average made 13.06%. The average return per year over 3 years was 11.34. And if we look at a longer period of time, which is much more reflective, 7.8%. Now, what I did, I took a different company to what I looked at in the previous ones. I think in the Kersham, I looked at examples from Migdal, so I purposely took a different company. So let's say looking at Phoenix, again, you'll see they have a number of different tracks. They've got bonds which aren't with any exposure to the stock market. They've got bonds but capping the stock market exposure to 15%. They've got a mixed fund. They've got an aggressive fund. They've got a track which goes according to Sharia law. So for people who are of the Muslim faith, who want to go via certain of Sharia regulations, they've actually lost some money. There's shekel linked, and there's also in recent what's become quite popular, funds that instead of being managed are tracking the S&P 500 index, which is an index which is in the States with big 500 companies, and it tracks how they are doing. And if we look again, different options, the higher risk ones tend to do better over time. Last year, 21% or 23.72% in the S&P. The lower risk one with the lower exposure to stock market made 4.66, but we look at the 5-year average. Not everyone's been opened for that long, so we don't have the data yet. But 11.55 in the more aggressive one, the mixed one 7.33 and 4.3%. Again, different exposures. So just to give an example of how to understand some of these. So looking at the mixed one, we see the stock market, they're about 2016, they were 23%, 21% the next year. Last year was the most 31%, but they tend to be somewhere between 20% and about 33% in the stock market. This one is the government bonds. Again, a mixed portfolio, but they're putting things in cash equivalents, even things like loans where they lend to other companies. Again, they're mixing the portfolio. And we see, we don't have full data for 2016 because they only open up towards the end of 2016, but we look at the annual returns. There was a minor dip in 2018, but they're averaging 7.33% since they were opened. And we see each year how they can go up and down. So they did lose 2% in 2018. But again, not to panic, because again, if you can afford for the long run to keep it there, it does make up the money. We're looking at the more aggressive fund, the Manayot. So the stock market, you'll see 90%. They took it down because of Corona a bit to 58% and kept a bit more in cash because they're a bit concerned of things. But in government bonds, you're seeing 0.00, 4.79 during Corona. But it's a much higher percentage in the stock market. Again, the returns will be higher. 2018, they actually ironically lost less because towards 2018, the markets recovered. So therefore, the stock market balanced. If these were going in 2008, we'd see much higher losses in 2008 on this. But again, over the same time, they're averaging 11.5%. We look at the lower risk one, which is without stocks. The stocks are 0.43, but very low, but less than 1%. Much more in government bonds and corporate bonds. And again, we're seeing the average of 4.3. Again, they still can lose, only lost 1.22% in 2018. But it tends to be, as one gets more money in their fund or close to where they want to maybe take money out, you can start off aggressive in a fund which has a great exposure to stock markets. And as one gets older, transpose it into a fund which may potentially have a lesser chance of losing money. So there are many different options. These are examples. And the fun question which people always ask, what are the fees? So fees will depend. Obviously, someone's got a lot of money, will be able to negotiate less. Different funds will offer different things. And from the money going in, we call deposit. And which means that if you're putting 1,000 shekel each month into the fund, they could take a certain percentage of that as a fee. There's also from the accumulation. What's in the overall fund, they take a certain percentage. Now, the maximum fees they can take is 4% and 1.05%. So 4% from the money going in, 1.05. But the common average fees is that most companies these days do not take any fee for the money going in, meaning that the entire amount going in should be free of fees. And instead of 1.05, you can get lower than this. But I just did a market research just to look at the common average fees, usually between 0.7 and 0.8. Obviously, someone's putting in a very small amount, may get towards the 0.8. Someone who's got a much higher amount, or someone going in an S&P 500 track may be able to get less because it's not a managed fund, so they sometimes take lower fees. But these are the average fees on that are taken. I guess that's pretty much something. I would just go through just a few things to sum things up. As I said, it's an excellent tool. You can both do monthly or lump sum amount. As you get closer to needing to access the money, consider changing to a more conservative investment track. It's a good option for the following people: salaried people with income that's higher than the salary that they get the pension on, or self-employed people who are much higher levels, as we showed you in the figures earlier. People looking to save money for children. This is a good vehicle, especially as it could potentially be there for a longer period of time. It can compound into a really, really nice amount for them. And also just general savings as well. It's a good option. And the other thing also, before you're thinking of withdrawing it, you consider the loan option. But again, I stress only if the repayments are affordable. That, in essence, sums things up. I guess we'll take any questions.
Yeah, there are some questions here. One that we'll try and get to all the questions, and anything we don't answer, we'll get on to Facebook later and just go through and answer. If someone is converting it to an annuity, over 60, 70, whatever, they convert it to annuity, does the fund grow, or they're given a set amount and that's it?
So they'll usually be given a set amount. The fund continues to grow because ultimately, if someone lives to 120 in a day, they're going to get more than what they've put in there. So that calculation it's still invested because the insurance. Let's say for simplistic mathematics, someone has got 1 million shekel in their fund, and they've decided that I want to take it out, and then let's say given a divisor of 250 months, so they're going to get 4,000 shekel a month. They think you're going to live on average for another 20 years and 10 months. So someone at age 67, they're going to live to 87, is what they think. So they will get 4,000 shekel a month. If they live until 106, they'll still get that 4,000 shekel a month for the rest of their life. So the question is a good question. The insurance company still invests it. They're not giving you that 1 million shekel in one lump sum. So they're taking that 1 million shekel to invest on the chance that that individual will live beyond what the prediction is. Now, the other question, which hasn't been asked, but I'm going to ask the other way. Let's say someone's 67 and they say, okay, I'm going to get 4,000 shekel a month, and they only live until 72. So they've only lived for 5 years. They've clearly got a lot less out. So a lot of these annuity plans will say, we will guarantee a minimum payout. The default option is usually about 240 months, 20 years worth. So if they lived for 5 years, there's in essence 15 years worth that they hadn't paid out. So they'll take the 4,000 shekel a month, multiply by 12, multiply by 15, and they will get the rest paid out to their beneficiaries as a lump sum. So the money is not lost as well. But again, when each individual person gets there, there would often be different options. Do you want to guarantee a minimum payout? Do you maybe want to take out some as a lump sum first and use that, and the rest have as annuity? Again, very, very flexible.
Right. The other question is, what if someone just leaves it in the Kupat Gemel Lehashkaa, does not convert it to an annuity, and they pass away? What happens with it? When it moves to the next generation?
Beneficiaries. They can nominate beneficiaries.
What's the tax benefit or not benefit? Like, what happens with the tax? Do you know?
So I'll be honest with you, I don't know what happens with the taxation there.
Okay.
I don't know. That's something which I'll have to look, and maybe I'll put on the Facebook group just to double check what happens out. The money does go. It's not going to be worse than the 25% taxation on the profits. There is no inheritance tax in Israel, so there's no extra taxation. The question would be, is there going to be any exemption from the 25% tax on the profits? But it's going to be no worse than that. But I'll have to check that, and maybe I'll respond in the comments.
Fine. Someone asked that. Okay, let's see what else. Does one have to take out the money on their own when necessary? Are there dividends? No, I think that's coming from like U.S. funds where like you have to take a certain amount per year. Here you do not have to convert it, and you don't have to take out a certain amount of money. You can leave it there. Okay, I think we've covered pretty much everyone. If I've skipped someone, sorry, and we will go to the questions in the Facebook group and ask them. Okay, Danny, thank you so much. Very informative as always. And thank you everyone for joining us. You're all learning to be financially smarter, which is our mission here. And have a great day.
Have a good day, everyone. Bye.